In this week's video, we'll review the hard evidence that tells us the odds of a more prolonged stock market correction are increasing. These are the topics we'll be touching on in this week's video. If you'd like to read these bullets in more detail, you can pause your video player. We'll look at the current reading of the CCM market model, look at some interesting DeMark counts, economically sensitive stocks, and we'll revisit the Tommy Hilfiger versus toothpaste chart. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. You might remember in recent weeks we've been talking about flat and indecisive markets where things can change quickly. This is a screenshot of the CCM master market model. We use this to manage risk. Your risk tolerance may vary. You can see here on April 8th, we are at a 50-50 split recommended by the model between risk assets and conservative assets. That is about as indecisive can be. You can see in one session, the model moved from 50% to 70%. That is extremely rare, and it backs up the theory that when you have flat indicators in an indecisive market, things can change quickly, and it's extremely important to remain flexible and open-minded. This is where we finished out the week. We did take a bond position this week. We only took a small position relative to this. Why? Because we're not that far away from this indecisive look, and these numbers could still shift back towards this end of the spectrum next week. So we'll continue to scale into the conservative side of the portfolio. We have to keep an eye on trades and tax implications, and we'll see what next week brings. We'll spend a brief amount of time reviewing DeMark counts on the S&P 500 index. DeMark charts and indicators are proprietary tools from Market Studies LLC. We have what's known as a qualified TDST break here on the daily chart of the S&P 500. I know it's qualified because it's bold. This is not qualified, nor is this break here. A qualified break tells us from a probabilistic perspective the probability of a trend reversal increases when you get a qualified bearish break of this TDST level, and we have it as of Friday's close. Moving on to the DeMark exhaustion count for the S&P 500, and everything in the world of DeMark, similar to what we do, speaks to probabilities. Those of you that know DeMark know when you get a 9 in blue here paired with a red 13, it tells us that the probability of trend exhaustion and a reversal has increased. So we have two things on this chart that tell us the probabilities are increasing that stocks could continue in this direction. Similar to the CCM market model, when you get counts that align in the world of DeMark in multiple time frames, it increases the probability that you have a good signal. We do have an active 913 probabilistic exhaustion signal that is still in force on the weekly chart of the S&P 500 as well. We also have active 9 and 13 probabilistic trend exhaustion signals on the monthly chart of the S&P 500. You can see when you have a 9 and a 13 here, the probability of a reversal increases. This was a good signal. This 9 here paired with this 13 helped identify this reversal. Here, the 9 and 13 did not result in a reversal, but it still gave us good information telling us here that this was a strong trend. A 9 and a 13 here is a probabilistic signal. It just tells us to keep an open mind that the odds are now greater that we might see some type of reversal in the S&P 500 index. This is a weekly chart of the S&P 500 index that's tracked by the CCM market model. The market model can answer binary questions about these moving averages and the weekly S&P 500 chart. Those of you that follow along on a regular basis know that a full bore bullish look is price above blue and red, blue above red, and the slopes are up. The probability of good things happening increases. Conversely, a bearish look is price below blue and red, blue below red, and the slopes are down. The probability of bad things happening increases. Bullish, good things happen. These moving averages help us discern between volatility to ignore, volatility to ignore, volatility to ignore, and volatility to respect. Last week we did not have a bearish moving average crossover. This week we do. Blue is now below red, and we have price below blue and red, and the slopes are down, telling us that the probability of ongoing weakness is now higher than it was a week ago. We've made defensive moves recently based upon the observable evidence. This is a tweet from April 4th saying that we're reducing our exposure on the growth side, and another one time-stamped on April 2nd. We're using the exact same trend concepts here on these three weekly charts. Remember, we were looking at resistance, resistance, support. Well, we broke support on the weekly chart of the S&P 500, and you can see the bearish moving average crossover that's in place now that was not in place last week. Would I rather be long or would I rather be short? You can see it too now has, instead of a mixed look last week, a full bore bearish look from a probabilistic perspective. We also have numerous trend reversal confirmations. A trend reversal occurs when three basic things happen. We break a bullish trend line as we did here. We make a lower high as we did here. This is a lower high relative to this high. And then it's confirmed from a probabilistic perspective with a lower low. This here is lower than this low here. Similar situation. Would I rather be in stocks? Or would I rather be in bonds? It too has a full bore bearish look from a probabilistic perspective. You can see now that we have a lower high and a lower low, which defines a weekly downtrend. How long will these charts trend in this direction? We have no idea. The way we manage risk is as long as the observable evidence says the odds are now shifting in a bearish manner, we will reduce risk. When the observable evidence improves and looks more like this, or this, we'll be happy to move our capital back in harm's way. This Friday's research post on short takes answers two major questions. How long can stock market corrections last? And how far can the S&P 500 fall? This is the weekly chart of small caps that we've looked at numerous times over the past several years. You can see small caps went sideways for 5 months here in 2011, which helped foreshadow this decline in the S&P 500. 3 months of consolidation here helped foreshadow this decline in the S&P 500. We now have roughly, and it's not a clean look because you've got higher highs, but we have gone sideways now for 5 months, telling us that our concerns should increase. This is the chart of higher beta stocks relative to the S&P 500 that we've tracked for quite some time. Higher beta stocks tend to be economically sensitive, things like consumer discretionary stocks and energy. You can see we have a bullish trend here. Now we have a downtrend that's in place. We're trying to get a full bore bearish look with a bearish moving average crossover. It's possible resistance, support, that we will hold here at support, but momentum looks very, very weak. Last Friday in an article dated April 4th, we said we were concerned about a non-confirmation under Dow theory. That non-confirmation is still in force, and we have additional things to be concerned about that we'll cover now. This is another weekly chart tracked by the CCM market model, all things being equal, you'd prefer the stock market to be above the 22-week moving average. When you drop below it, the probability of bad things happening increases. We are now below the 22-week moving average for the first time in quite some time. We also know that when momentum is in overbought territory, the probability of good things happening increases. Conversely, when we drop out of overbought territory on a weekly closing basis, the probability of bad things happening increases. We are out of overbought territory. Until this chart starts to improve, it will check bearish boxes in the CCM market model. Everything that we just said about the chart of the S&P 500 applies to this chart of the Nasdaq. We are well out of overbought territory with extremely weak momentum. Now what we'll be looking for, the probability of good things happening will increase when this leaves oversold territory. When you leave oversold territory, the probability of good things happening starts to move in the right direction. We're not there yet. This is the chart or ratio, risk on, risk off ratio tracked by the market model, one of many charts and ratios tracked by the model. Consumer discretionary, risk on relative to consumer staple stocks, or risk off. You can think of it as Tommy Hilfiger versus toothpaste, or I am confident about future economic outcomes relative to I am nervous about future economic outcomes. You can see here when the ratio gets weak, it helped foreshadow this waterfall decline in the S&P 500. This ratio has looked healthy until recently, and now it looks extremely weak. We'd like to see this chart improve and look more like this or this, and have the ratio be making a series of higher highs and higher lows rather than making a series of lower lows and lower highs. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.